Imagine making $50,000 a month, thinking you can afford any home but getting denied because you're broke. The truth is, it doesn't matter how much income you make if you're not keeping most of it. If you're thinking about buying a home, stop scrolling Zillow right now. Before touring homes and saving 100 homes into your Zillow account, the single most important thing, more important than talking to a realtor like myself, even more critical than getting pre-approved by a lender, is knowing your DTI. Knowing this number will help you narrow down your home search and budget by acting your wage. Understand it and you can essentially pre-qualify yourself without ever having to fill out a loan application or getting a hard credit check. So before you attend those open houses and waste everyone's time, let's get crystal clear on what DTI is and why it matters the most. DTI is an acronym for debt to income. It means exactly what it sounds like. How much debt you have against your income. Easiest way to understand it is what is earned minus what is spent. Mortgage lenders use this ratio to determine if you can comfortably afford a monthly mortgage payment. You can have a credit score of 700 plus, but combine that with a debt to income ratio of 65% and now your credit means shit. In this video, I'm going to show you the easiest way to calculate your debt to income ratio in the comfort of your couch so you can know how much house you can afford. DTI is going to vary from each specific loan type, but in general, lenders want your DTI to be 45% or lower. So in order to break down your personal DTI, you need to know what all goes into the formula. To calculate your debt to income, take your monthly debt payments, divide it by your gross monthly income, and multiply that by 100. This may not make sense to you right now, but we're going to go over some examples together here shortly. If your DTI is too high, this means you're already spending a large portion of your income on debt payments. This can make it very difficult for you to make a mortgage payment if your income decreases or your expenses increase. Let's get into what counts as debt and what counts as income. When lenders calculate your DTI, they include earned income such as your W-2 employee wage or salary, consistent bonuses, commissions, Social Security, rental properties, and alimony or child support. What's not included are things like inconsistent money such as one-time bonuses, lottery prizes, gifts, or side gigs you don't report will not be considered. Understanding exactly which expenses count can significantly impact your home buying journey. Expenses that lenders factor into your debt include car payments, credit cards, child support, and other regular monthly obligations. Calculating your DTI is straightforward. Take your monthly income, multiply by 45%, and subtract all your monthly debts. Now that you know the formula, let's take a look at some clear examples. So for this first example, let's just pretend you have an income of $96,000 a year. We're going to divide this by 12 months to get your monthly income, and that's going to give you $8,000. From this $8,000, we're going to do the 45% that a typical lender is going to use. So you're going to times this by 45%, and that's going to give you $3,600. $3,600 is going to be your monthly allowance for a mortgage payment. Remember, you have other debt obligations such as your car payments, credit cards, student loans, whatever it is you may have, any revolving credit. So let's go ahead and pretend you have a car payment of $500 and you have a student loan of $50. And you have a monthly minimum payment on your credit card, you have a monthly minimum of $75. It's going to give you a total of $2,975. Let's go again. You have a yearly income of $96,000. Divide that by 12 to get your monthly gross income of $8,000. Times that by 45%. Now that gives you $3,600. Minus your car payment of $500, minus student loans of $50, and then minus credit card minimum payment only of $75. That gives you a total of $2,975. Based off of these numbers, this is what a lender is going to approve you. Your max monthly mortgage that they're going to allow is $2,975. All right, let's take a look at another example. Let's pretend you make $75,000 a year. Now you're going to go ahead and divide that by 12. Remember, 12 months gives you a total of $6,250. We're going to times this by the DTI rule of 45%. That's going to give you a total of $3,200. That was $75,000 a year that you make. Divide that by 12 months gives you a total of $6,250. DTI max rule of 45% gives you a total max monthly allowable mortgage payment of $3,200. So let's go ahead and pretend that you have, in this example, a $750 truck payment, and you took out lots of student loans. So you have $150 in student loans. Let's say you are responsible and have $50 minimum credit card. So that's going to give you a total of $2,250. So your max allowable monthly mortgage payment is going to be $2,250. Now, you're wondering, how do I figure out how much house I can afford based off of this? So based off of that, let's go ahead and plug these numbers in. Lucky for you, I have a calculator that you can use. Okay, now that you figured out your DTI, I'm going to provide this affordability calculator that's on my website. And we'll pretend you're in the Austin area, because if you're not in the Austin area, once you figure out how much house you can afford, it's only going to populate houses in the Austin area. I'll provide a link to another affordability calculator, but you can go on Zillow or anything else to find properties that you can afford based off your DTI. And it'll give you the max purchase price that you're able to afford for a purchase. So let's go ahead and pretend you have $96,000 annual income, $10,000 down payment, $765 in monthly debts. There's another website, mortgagerates.com or .gov, something like that. I'll put in the description. You can click that and find out what the current interest rate is. Right now, it is at 6.57. Property taxes is automatically defaulted to 2%. Homeowners insurance is automatically at $1,500, but we're going to go ahead and overestimate. We're going to go ahead and put it at $2,000. If you're looking at homes that are in an HOA, go ahead and just put $50. That's about average. You're going to click calculate. That's going to give you your monthly payment at $2,800. And right up here, you can see that it gives you how much house you can afford up to. In this example, it's $333,000. Then you can go ahead and click view affordable properties, and it's going to give you affordable properties in the area. Again, if you're in the Austin area, it'll automatically populate those for you. Then you can start seeing what you can afford. Now, if you're looking at new build homes, those are going to have lower interest rates. So let's go ahead and pretend you're looking at a new build home. Depending on which new build community you're looking at, they're going to have different rates, but we'll go with DR Horton right now. That's at 3.99%. To keep everything else the same, we'll click calculate. Your monthly payment, you can see it stays the same, but the home you can afford up to goes up. So with a 3.99 rate, it goes to $414,000, opposed to a 6.57. That goes back down to a $333,000. So let's go ahead and give you another example. Let's go ahead and say you make $81,000, $10,000 down payment. Your monthly debts are $625 in this example. Interest rate, you're looking at new builds. That's a 3.99, gives you a $348,000 house. Now, if you had zero debt, you can afford a house up to $3,038, and you can afford a house up to $445,000. Let's put that $625 again so you can see. Brings it down to $348,000. Having little to no debts can have a major impact on the house you can afford and up to how much monthly mortgage payment you can afford. If you're in the Austin area, feel free to use my affordability calculator, but if you're not, I'm going to provide other links so you can still play with it. Now that you have this information and want to get started in the home buying process, I have partnered with agents in all 50 states that can guide you in your home buying journey. Click the link in the description and I can match you with someone in your area. Or if you just need someone to help run your personal DTI, feel free to schedule a free Zoom with me and we will work on your DTI together. If you found this video useful, make sure you like and subscribe.